Hello, it's Jeffrey Cohen, Chicago Quantum, US Advanced Computing Infrastructures, Inc. I am an investment advisor representative and president of the company. And I'm going to talk to you today about top dividend stocks. These are the top dividend stocks we found as of last night running our model. And they're either hitting the definition as we formed here, which is they hit all 5 attributes, or they're just really interesting stocks that paid more dividends than the S&P 500. And we're going to walk through them for you, and we're going to talk about them. By the way, if you have questions, go ahead in the chat. Go ahead and ask me anything. Ask about a stock, anything, and glad to talk about it. So we're going to start off with what are the 5 rules. The first is U.S. listed stocks. They're U.S. They trade it every day. They pass all of our data validation. They're profitable. So the green ones in the spreadsheet to the left are profitable. The ones in the red are not profitable. And so there are still some good dividend payers there we're going to look at. But they don't make our list. The efficiency is better. So the risk versus return trade-off for an individual stock is better than the S&P 500. Now there aren't many of those, because the S&P 500 is actually the 26th most efficient stock in the run. So we've got the 5 on our website, which we'll talk about. But there's others. In fact, there's money losers that are more efficient than the S&P 500. In fact, none of them pay a high dividend. But there's just a whole bunch of stocks that pay a high dividend, and we're going to talk about them. Finally, the dividends paid are greater than the S&P 500. And so let's dig right in. Who are the money makers who have the great dividends? And so they're highlighted in green. So we're going to make this nice and big for you. Highlighted in green because green is anything more than the S&P 500 paid. And so I guess what I can do to make it easier is I can do some formatting on the cell. I don't want to spend too much time on it, right? So this is a number, and we want there. That's just a very simple way to look at the dividend. 1.05 would be like a 5% dividend, rounded up. So Blackstone, money manager, manages very large real estate investments for clients. Probably in the business of making what they call 220. So what that means is 2% of money managed, 20% of the profit over the standard benchmark. It's a very profitable company. Blackstone paid a 5% dividend. And in fact, the price of the stock is really, really low. It's 77% of the price of the stock last year. So that's great, right? Because that says, all right, I got a winner here, right? Winner, winner, chicken dinner on Blackstone. If you believe, truthfully, I believe. I don't think people are going to stop investing. Microchip technology, relatively new, paid a 2% dividend, so not great. Stocks up 3% over the year. Carlyle Group paid a 3% dividend. So you might be wondering, why am I pointing out stocks with a 2, 3, and 4% dividend? Because it's better than the S&P 500, which is paying 1.5. So Carlyle Group, in fact, the price is down 15%. Pays 3%. T. Rowe Price paying 4%, another money manager, more on the retail side, on the fund management side. And then Skyworks Solutions paying 2%. But what I now want to do is I'm going to show you the stocks of the money losers. And so these are the stocks that used to earn money, paid a very large dividend last year, and the stocks have probably dropped in price so much that if they ever did make a big payout, you're going to do really well. And what we're going to do is we're going to sort by dividend payout, just so you can get a feel for it. Who are these big money dividend payers who are now losing money? And so Armor Residential REIT. So REITs can lose money. It's great. It's okay. But imagine a residential REIT charging 20% more for rent. That sounds like a great deal, right? And if we take a look at Armor and we look at the closing price versus the average over the past year, you're going to see that this is a stock. In fact, this is one that I probably want to take a look at. This is a stock down 12%. Okay, Armor Residential. ARR. It paid an 18% dividend. Icon Enterprises, Carl Icahn Energy. Now you got Necessary Retail REIT, paid 12% last year. This is a company that does, real estate. Again, real estate. Probably the same here for Chimera and AGNC and Mortgage Capital and Healthcare REITs, right? These are REITs. And so if you believe that the real estate market's going to do fine, you probably want to take a look. Truthfully, I love this one. I love Armor, right? And so that 18% dividend, down 12% over the year. You got to do your homework. But wow, is that interesting. Crestwood Equity Partners. This is a company that does oil and gas services, pipelines, right? So they're going to pay out. It's an LP, right? It's a traded limited partnership, a master limited partnership. Paid a 10% dividend, down 2% over last year. If you believe oil and gas is going to go back up, they're probably going to do great. B. Riley Financial, I just laugh at because B. Riley Financial is down 29% over last year. They are the company that does, initial public offerings and equity raises for small cap companies. Charge an arm and a leg. So, of course, next year is going to be really rough for IPOs and M&A activity. But paid 8% last year, down 29%. If you believe that that industry can survive, B. Riley could be very interesting. Also, Loan Depot. Loan Depot does consumer real estate loans. If you believe that people are going to still be borrowing money to buy homes, Loan Depot paid 6% last year. Stock is down 26%. That's interesting, right? So I'm going to highlight those. And at the very end of the video, I'm going to come back. I'm looking. I don't see any chats. Wish I did. Come on, guys. Chat me up. I love it. Or just chat with each other even if you want. So there's Armor, Invesco Mortgage Capital. Again, do you believe, right? Crestwood. Do you believe oil and gas? I can't tell you about the management team. I've been interested in other master limited partnerships, but Crestwood, maybe not so bad. And by the way, Equitrans Midstream, another pipeline company. Interesting, down 12%. And Loan Depot, we talked about B. Riley, and that's a good place to start. So those are our money losers. So let's go back to our money makers, right? And by the way, you can always go to the website. It's Chicago Quantum /dividends. ChicagoQuantum.com/dividends. And you'll see the top dividend stocks, and you'll see all the stocks that paid 7% or more dividends. It's actually I don't even know why we share it. We share it so that you guys get all excited, maybe you get addicted to all this great data, and then you want to buy the data from us, so we give it to just you really fast. Maybe we walk you through it. That's how we earn our living. It's a nice thing to do, right? So that's up to you guys. Let's take a look at the money makers. And here, same thing. So let's dig in. If we just look at the companies that were better than the S&P 500, that were profitable, you saw it was those 5. And then some companies that come right after the S&P 500, Invesco. So Invesco makes and sells the ETFs and the investment products. And what's interesting there is the stock's up 3% over last year. 5% dividend, and I see them all over the place. Morton Arboretum, down in San Antonio, all over Chicago, doing fundraising and charity work. I think it's terrific, right? And so I'm going to highlight them at a 5% dividend because I don't know anybody else that's going to be mastering the ETF business, right? That's pretty cool. And so we're going to do the same thing. We're going to sort descending by dividend. And just for giggles here, I'm going to take the last day closing price. And if those stocks are down, let's say you like a discount, right? So if it's less than 0.80, if it's down 20% or more, let's put them in green. Because I'd like to know. Maybe there's some bargains, right? Bargains in the house. I love bargains. So let's take a look. Well, we take a look at the dividends. And right away you see Dorian LPG Limited. No idea what they do. Albertsons is interesting. 34% dividend. Right? So grocery. Maybe grocery's doing better in an inflation market. That's a really interesting bet there. You have another limited partner, CVR Partners. I don't know what they do. Genco Shipping. Again, don't know what they do. I don't really know them that well. Here's an interesting one. European Wax Center. Normally I'd make a joke, right, about let's go get a wax job, right? Wax poetic, whatever. But, I found one of these in the town over from ours, European Wax Center. It's like a little salon that you go and you get your beauty done, right? It's kind of like some of the more expensive fashion places that we have around here in Highland Park. Tricosi, like some of the ones that actually offer training services. And so stock's down 33%. It paid a 16% dividend last year. Worth a look. El Pollo Loco Holdings, 16% dividend, right? They sell chicken to eat. Inflation's up. They must have figured out how to raise prices. Then we keep going through. US Compression Partners, right? That's up 12%. They're in the oil and gas business. So again, do you believe, right? I believe oil and gas is going to do just fine. Rocket Companies is a residential mortgage company, residential mortgage licensee. They also do their own origination. They hold the money on their books. So if you believe in mortgages, you believe in rocket companies. American Financial Group, New Star, Blackstone Materials, Amerisafe. But who do I know and who do I really like here? That's paying Antero Midstream, another pipeline company, up 10% for the year, paid a 9% dividend. You're not going to starve with a 9% dividend in a pipeline company, most likely well run with long-term contracts. Not going to do badly at all. You see Magellan Midstream. Artisan Partners is interesting. So they're an asset management firm. So they're like a 220 firm, right? So they're managing money for people. Their stock is down 8% over last year, paid a 9% dividend. Interesting, right? Very, Energy Transfer, another oil and gas services company. So Lumen Technologies is interesting. This is a business-to-business cloud company. Think of it, they do data center hosting and all that kind of stuff. They're not like a T-Mobile or Verizon. They're not pure, but they provide communications-related services to businesses. And the stock's down 42% over last year, and it paid an 8% dividend on the actual price of last year. That's a B2B. That's an anti-recession bet. That's an interesting bet. Then you got a whole bunch of master limited partnerships, which great. And then you've got your telcos, right? And so you can see AT&T here, which again, I'm not a big AT&T guy. I actually canceled AT&T and went to a different home internet service, and then canceled and went to another home internet service. And I now pay like $35 a month for high-speed internet. Some tremendously cheap price. And so I don't know that AT&T makes it, but, 7% dividend. Get paid while you wait. I know Verizon is close at hand there. So that's about it. So I talked to you about a few different kinds of stocks. Okay, the first thing I talked about is master limited partnerships. Oil and gas industry. with long-term contracts that are going to help you out, right? You're going to buy. They may not even be that well managed. Maybe the general partners rip you off. It actually doesn't matter because at the end of the day, they're trying to pay out and distribute cash, 90% if possible of all the cash they generate. That's REITs, that's master limited partnerships. The REITs do the 90%. Master limited partners, they really distribute all that they can. And in fact, the good news is a lot of them, if they lose money, if they're in the red spreadsheet, you actually get a loss on your taxes for that year. I don't know, if you've got income and you want to nail it with a loss, there's your master limited partnership. So master limited partnerships are very complex from a tax perspective. So if you see that LP at the end of it, talk to your tax accountant or tax attorney. Make sure you understand how to manage basis of those investments, things like that, and whether there's any contingent liability, whether there's recourse. Maybe they can come to you if they start losing money and you got to pay for it. So got to be really careful there. So first thing we're going to do, we're going to start with the money-losing companies. And then what I'll do is I'll send out a memo. If you want one, just shoot me an email at, let's see if I can give you the email address here. Shoot me an email. And I'll send you the name of all these companies. My email is jeffrey@quantum-usaci.com. We're also available at jeffrey@chicagoquantum.com. And phone number, it's 1-312-515-7333. Email works best if you hit me up here. And I'm Jeffrey Cohen, a registered investment advisor in Illinois. So if you're an Illinois resident, if you're passing through Illinois, you do business in Illinois, you live in Illinois, it's much easier for me to help you. If you're not in Illinois, I can still help you. But I have to keep track of how many people I'm serving as paying customers in every given jurisdiction. And if I end up with a lot of customers in a certain area, I got to pay a couple $100 to that state's regulator to maintain our regulatory compliance. And I'm happy to do that. So here's how you reach me. So let's go. Armor Residential REIT, paying a tremendous dividend, 18% last year. So they paid a tremendous dividend. We look at what they paid, not what they're paying in the future, because I think the past is a reasonable way to look at it and compare the companies. None of these stocks may pay a dividend ever in the future, but they paid a lot in the past, so it's something to look at. Armor Residential REIT, ARR, Invesco Mortgage Capital, Crestwood Equity Partners, which I'm going to take a look at, to be honest. You got a couple other REITs. You got B. Riley Financial. Will they make it? I just hope they don't have exposure to that Sam Blackstone guy with the crypto stealing everyone's money. Equitrans Midstream and Loan Depot were ones that I thought were interesting from a dividend perspective that could really maybe have some play. And I'm just taking a last look here, scrolling down the screen. Ares Management, not bad, but they're only paying 3%, so why bother with a money loser? Now let's go with the money makers. I'm curious what the story is with Albertsons, so it's probably worth a look. Did they spin something off? I mean, how'd they pay 34% dividend last year? That's crazy talk. European Wax Center, 16% dividend, down 33% from last year. El Pollo Loco Holdings. I know you've driven by the restaurants with the crazy chicken. 16% dividend. That's crazy talk. And it's up 3%. It's not a dog stock. US Compression Partners. They sell compression equipment, oil and gas industry. Rocket Companies. Rocket Mortgage. Right? It's a tough business right now. And mortgage growth is negative and it's low. But if they make it, they like to pay a dividend. They're probably very profitable. Right? We keep going through. I'm looking for companies that I have like specific knowledge about. Antero Midstream, well run, paid 9%, but it's up 10%. So if you owned it last year, they probably paid 11%, and it was up 10%. So you made a lot of money. Artisan Partners Asset Management. I've been looking at them for a while. 9% dividend. It's down 8%. It's always tough right now because companies are really struggling with less IPOs, less M&A, less just activity in the market, less trading. You know, one I don't really talk about much, right, is Altria Group, cigarette company. 8% dividend. 100% of the stock just hasn't changed since last year. It's fine. Bunch of master limited partnerships, Plains All American, Enterprise Products, Energy Transfer, Holly Energy Partners, Sunoco. You know, I'm surprised I don't see Saudi Aramco LP in here, except it's not U.S. listed, right? Lots of companies, Hess Midstream, they take their oil and gas pipeline and fixed assets, their distribution systems. You know, the places where you go and you ship in the natural gas and you process it, and then you maybe put it in tank cars or you put it in other pipelines. It's good business, right? And these are all over 100%, so they've all gone up in the past year. Nice dividends. And then you got your telcos. So you got AT&T. I don't know why I'm not finding Verizon. That's interesting to me. I guess that's about it. I didn't really find much else here. I'm looking. I mean, Kinder Morgan, right? Another pipeline company, paid 6%, but that was such a big company. It's almost too hard for them to move around. No, I think we got it. I mean, here's Verizon down 9%. So, thank you very much for watching. Again, reach out. I'd be happy to send you a list. And good luck in the market. So what happens is you get all these dividends and you're going to have to pay tax on them. So if you can, maybe you hold these high dividend paying stocks in a retirement account or a tax-free account. That might make it easier for you. Now, personally, I don't trade stocks in my retirement accounts. I do it all in my kind of fun account, which is taxable. And so I end up paying tax on this and declaring the income. But it's not bad. You know, it's money. It comes in every month or every quarter. It's nice. Maybe you can earn 5-10%. Now, I will say this, just to diverge a little bit, right? So, Jeffrey, what if I don't want to do that? What if I don't want to buy stocks? What if stocks aren't the answer for me? Well, let me give you the other answer then. You could go to a very happy place. I'm going to find it for you. You can go to treasurydirect.com. You could go and buy bonds. If you're a U.S. citizen or a U.S. registered entity, right? You can buy bonds. You can say, you know what? I want to put money away for 13 weeks. I don't want to worry. I want to put money away for 13 weeks. The auction's on the 9th. And so I click on my 13 week and I realize, oh my God, they're going to be auctioning off $20 billion. Maximum award to any one person. So if you wanted to put $20 billion to work, go for it. But let's say you're like me and you want to put $1,000 to work or $10,000 to work. So what happens is they pretty much always accept the non-competitive offers. It's a pretty good interest rate. So Jeffrey, what's the interest rate? Well, to be honest, I don't know. I have to look at Yahoo Finance because I wasn't thinking that I was going to be telling you to buy 13-week bonds. But let's take a look because I'm just curious, right? What if you didn't want to take the risk to earn 6%? What if you just wanted a 13-week treasury bill? And you can do it. There's no cost. You do it through the government. There's no risk. It's like the riskless asset. You could earn, if the auction was today, it'd be paying 4.5%. Who doesn't love 4.5%? Risk-free. No assets, no commissions, no spread, no nothing. No getting it right. Oh my God, the Verizon CEO's a knucklehead. He said something stupid. Stock went down 10%. No. You just earned 4.5% for nothing, right? So there are other options if you're a dividend investor. And this is a very clean one. Now, you could say, I want a 1-year Treasury. Jeff, talk to me about the 1 year. But just, you see the point. You go to treasurydirect.gov. It's a government website. Upcoming auction. You deposit the money. You open up an account. And then you make a bid, like on the 13-week. You could do the 26-week. Up and coming, you got a 3-year, a 9-year, and 10-month. I don't know that I want to buy long bonds. I think that's risky. But hey, for 13 weeks, for 3 months, I'm getting 4.5% interest. That's great, right? I wonder what I get on a 26-week. Now, the 26-week, right? Again, I don't know your situation, right? We got to work together. But if you want to put money away for 182 days, they're going to be auctioning off $48 billion. If you wanted to put $16.8 billion to work, I can work with you. We can work with the Treasury, right? But it's just so interesting because if you just want to put in a couple thousand or 100 grand, non-competitive, you drop it in, and now there's a 26-week, and it's hard for me to figure out what that 26-week yield curve is because what I've got is I got the 13-week and I got the 5-year here. If I go to a different website, I could look at a 1-year Treasury bill. Now, the 1-year Treasury is 4.8 and a quarter, 4.825. So for a year, I can earn. So let's assume 13 weeks is going to be somewhere between those two. So it's going to be between 4.5 and 4.8 and a quarter. Let's say you get 4.7. That's great. 4.7% interest for a year. And there's no spread, there's no cost, there's no risk. It's a Treasury, right? Love it. And that thing is up 9 basis points. So I got to tell you, I love the idea of earning 4.8%. I mean, that's like a dividend without any equity risk. It's pretty nice. You'll pay tax on it. Trust me, you're going to pay tax on this, right? It's not tax-free. It's a federal bond. It's not like a state bond or a local municipal bond where you can get like triple tax-free, like a Puerto Rico bond or whatever. But I'm just saying, risk-free, 4.825% for a year, 4.5%, 4.5% if you want to put your money away for 13 weeks. It's a nice alternative, right? Do you guys want to know what the S&P 500 actually paid in interest last year? Are you interested? I'm interested. What did the S&P 500 pay last year? The S&P 500 is down 6% on versus the average price of last year. That's actually not that much. You look at a lot of charts and stuff, like I'm looking right here on my up run, and it shows that the S&P 500 is dog meat. It's terrible. It's down 19% right before dividends. And I look at that and I think, why would I ever want to hold the S&P 500? But then I look at here and I realize it's really only down 6% versus the average of last year. So if you bought every month, you bought some, you're down 6%. The dividend, though, that it paid is 1.55%. So you bought the S&P 500, you bought all the growth stocks, all the big stocks. It's market cap weighted, and it's risk adjusted. It's a beautiful investment. But you lost 6% and you earned 1.5% in dividends. What I like is when you can buy some of these crazy dividend stocks. Like even something like a Blackstone pays 5% dividend. And wow, is it down? It's down 23%, whereas the S&P 500 is down 6%. So if you can get your head around Blackstone, you can get your head around earning 5% and maybe some capital appreciation if they make it, if they survive. And I think the Fed is looking out for companies like Blackstone to make sure that they do survive. So, all right, top dividend stocks, we covered them. Reach out to me. I will get you the list if that's important to you, and I can be reached here. Of course, I'd love to be helping people, right? Now, we have a fund that we that we manage for people. It's actually a trading strategy that we put together based on our runs. You can buy the run, do it yourself, or you can hire us to do it for you. Either way, it actually doesn't really matter. It's kind of a break even between the two. So, and again, thanks. Really appreciate you watching. And last but not least, if you want to learn more, just go to chicagoquantum.com, market information, top dividend stocks. And we publish a list of the top dividend stocks. We have all this commentary, and then we publish all of the stocks that pay 7% or more dividend last year, both money-making and money-losing companies. So you can build a list yourself. You don't have to pay us to do it. I don't do this every day. Sometimes I don't do it for a week or two, so you might have slightly older data. And that's why you buy the run, you buy the work, and then we get it to you every day if you'd like. So thanks again. Talk to you later. Bye-bye now.